and what we could expect in the market over the next few months. And I will come quite rapidly to the conclusion that I don't know if you know the movie El Día de la Marmota. You know the movie? And I think we are a little bit there. You know, each time we say, oh, now we have reflation. We will have a lot of growth, inflation will pick up, central banks will normalize. We want to believe to this dream because it's quite boring also to myself to come each year here and say rates will stay low, economic growth will disappoint, inflation will remain low, and central bank will be very accommodative. But I find myself each year to come here and say the same story. So I guess you are a little bit bored by that, and so it's very easy to believe or to want to believe that things will change. But I suspect that in a few months' time you will have the reality check and you will see that we are back in the same kind of story. So that's a little bit already the end. So let's have a look a little bit more in details at what we believe, why we believe is like that. The good news this year was, you remember last year was a year of divergences. Divergences between the manufacturing sectors that was struggling and the services sectors, the consumer that were doing fine. Divergences between the developed world that was doing fine and the emerging market that had a lot of trouble. This year, because the dollar stopped to get stronger, at least till recently, because of the Fed was not really able to hike, you had a kind of convergences, and on top of that, an acceleration in economic growth. And you can see here from both the PMI in the world, the gray line representing the services sectors and the blue line, the manufacturing sectors. The same here, you have composite PMI, but we have split in between developed world and emerging world. And you see that you have less divergences, and the good news is that both are going up. Here you have a more precise view by countries for both the manufacturing sectors and for the services sector. It's very easy to read. When you are above the 50 line, it means that you are in expansion. Below, it's that you are in contraction. When you are on the right, it means that the trend is improving. On the left, is deteriorating. And you see that most of the countries emerging in yellow or developed world have gone in that direction over the last few months. That is quite good, expansion, improving. And for services also, it's not so clear in terms of direction, but expansion, it's quite confirmed. So that's why also the market is believing that we are heading into another normalization, because it's kind of, you have the proof by the data. The problem is that these data are based on the environment that was 2 or 3 months ago. It doesn't yet integrate the fact that rates are now higher, the dollar is getting stronger, and you have kind of uncertainties about what will happen next year. So there is a little bit of lag between the transmission of the environment and the result in the economy. So I suspect that that trend may continue perhaps for next 2 or 3 months, but at some point it will stop, and again there will be a reality check and at least a kind of stabilization. Just looking at the US economy, you see what has happened, but I have shown here the US economy, but it's true for most of the economies. If they were not consumer, we would have been in recession. You have the GDP in blue, the US GDP, it's the year-over-year changes, and in gray you have the consumption, and in the yellow, the rest of the economy. So it's true that consumption is a big part, is almost 70%. But the other part has really been in a big drag and a problem for growth, essentially investment. Recently, you had good data for capital goods order yesterday in the US. It means that probably the worst is over, but it's not because the worst is over that it means that you will have a lot of growth coming from investment. Now, if I speak a little bit of Mr. Trump, because you know, there is now big hope that he will push infrastructure spending, so probably it will be positive for CapEx. The problem as I have today is that even assuming that Republicans give him free hands to go ahead with his infrastructure spending, he won't be in the GDP before 2018 because he needs at least 3 to 6 months to go through the Congress, then 3 to 6 months to put the money at work, and then you will see better economic data in 2018. And that is assuming that he has free hands, which I am not yet sure. And another point is that people now tend to assume that till now it was quite easy to read. You had neutral to slightly austerity in the fiscal part, and you had a lot of accommodation in the monetary part. What will happen if really you have more growth or more fiscal easing, you will have less monetary policy accommodation. And so it means that what you earn on one side, you are losing at least to some extent in the other side of the monetary of the economic policy. And you know the Fed, they have here, you have the dots. So that is the latest Fed members' projection about what could be the Fed fund rate in the future. Here is just the point 2 years ago, 18 months ago, 12 months ago. So they have constantly revised down. And you know that in December you have the meeting. Now everybody expect a hike. And what we fear is that if the Fed doesn't change the dots, it means that the Fed don't believe in the Trump program. And so some investor will start to say, why they don't believe? We believe, why they don't believe? Perhaps they know something we don't know. If they say, we don't know, but there is a risk that Trump is able to push that, it means that this point will move here. Perhaps not the final point, but at least you will have some front-loaded point, and that will push again the dollar higher. And it's like, if the dollar is too strong, if rates are too strong, they are doing the work of the Fed, and so the Fed is not able to hike. So you always come to the same situation where it's difficult to see more rate hike. And people tend to forget that the current structural backdrop of the economy is a world of very unfavorable demographic trend because of aging population, except a few emerging countries, but in the developed world it's like that. Very low productivity, and even if Trump does some infrastructure plan, I don't think it will change dramatically the productivity problem in the US and in the developed world. And last but not the least, because we could cope with very low growth. We could all cope with very low growth. The problem is that the debt level is quite high. So you have to service the debt. And if you have low growth, low inflation, you cannot really have a sustainable pace to sustain the debt. And so because of the three key elements, rates will have difficulty to increase. Yes, you can have some spike. Yes, you can have some hope. But to have on a sustainable manner more higher rates, I don't believe this story. I don't believe, and I am quite sure that in 12 months' time, rates will not be higher than the current level, and probably even lower. European economy, sorry for being the killjoy of the evening. I would say the good news is that now that rates have increased, perhaps they have overshoot, perhaps, it opened again some opportunities for next year. Because 2 months ago, it was very difficult to say there is some room again to make some money in bonds. It was very stretched, not only on the govies, but also in the credit space, in the emerging debt space. And now you have again, because of this movement on rates, some opportunities for next year. European is going better than expected. You had recently good data also. We are at the beginning of the recovery. So it's not really a risk of having a big decline in economic activity in Europe. You have still some pent-up demand, catch up, because actually you had a recession. We had a recession just 2 years ago. So unemployment rate is still declining. And I think that the political challenges will be perhaps less than what we have feared. I will touch a word later on that. And one of our view on the ECB is that the ECB will extend the quantitative easing in December. They will probably announce an extension of 6 months of the same amount. Why they will do that? It's because now rates have increased and they are not very happy with that, because the increase in rates, it's not only due to the fact that the economy was okay, it was due to the increase in US interest rate. But I haven't heard Mr. Trump saying that he will do some infrastructure spending in Europe. Huh? It was essentially the US. So inflation is still very far from the target of the ECB. So there is no reason for the ECB to put at risk the recovery and the good trend in inflation by tapering now. It's too early, I believe. One of the key problems I have, and as I think is a key risk for 2017 or perhaps later, is China. China, if you remember, 2015, it was all about China, its currency, what was happening there. And suddenly, in 2016, China disappeared from the radar. But the problem is still there. It's just that you put the dust under the carpet, but you still have the dust under the carpet. The dust didn't disappear. And the problem is that growth is structurally getting slower. That is structural. And the level of debt continue to pile up. And so the problem just gets bigger. And you can see that in some form here, where you have the nominal GDP running, if you believe the official numbers, around 7-8%. And here you have the credit growth, which is at 12-13%. So debt to GDP level in China before the crisis, taking into account government, household, companies, was 80%. It is now 200%. Okay? So it's the same amount that many developed economies. But it's not yet developed. I remember that Chinese average household, they earn less than $10,000 per month. So it's 10,000 per year, sorry for that. So it's not the same standard of living that we have in Europe. So it's an accident waiting to happen. And the stronger the dollar it is, the higher interest rates are, the bigger the chances that you have a problem. And you know what? The day where you have a problem in China, what will be the final result? China will export all its deflation. And so, it's as I said, if rates goes too high, if dollar goes too strong, if the market start to believe too much in this reflation story, you will finally trigger a big accident in China, with the final outcome being perhaps worse than what we have experienced over the last 2 years. So the only way to go through that, there is a solution. It's to go very gradually. And currently, it's not gradually. It's an overshoot. It's just people have bought hope. I haven't seen numbers that inflation expectation jump from 1.6 to 2% in 1 week. What is the fundamental reason of that? Nothing. And that is the real danger of the market. Is the market himself creating the danger. So what has changed in our economic scenario? Here you have what I will call the central scenario, which is the one that I have described. It's not so gloom. It's just that growth remains quite moderate, stable, but positive. Inflation, it's okay, but I will say below the target, but better than we had this year. And central banks, however, they remain accommodative. We expect the Fed to hike only once, perhaps twice next year, because of the problem I told you before. And on top of that, ECB and Bank of Japan will continue to provide liquidity to the total financial condition. What has really changed is the probability we give to each of our scenario. Last year, we have the kind of same scenario, but here the probability was 80%. And now we recognize that with Trump and with kind of political uncertainty, you have more chances to end the year in the tails. So to have a negative scenario, let's say, for example, China problem, or to have perhaps, I am too pessimistic, Trump will be able to push and I am the wrong guy, and you will see some inflation and normalization. And so we have increased also a little bit the probability of a better scenario than what we have described. Just a few words, what I think political uncertainties in Europe will disappear. First of all, it could start already on this Sunday. You have seen, for those who have followed the French election or the primary election for the right wing, the big surprise was Fillon. Fillon, it's a really far right guy. It was not the favorite was Juppé. So big surprise. And I suspect that what has happened is that many people from the left went to vote to the right candidate, and the only scope they had was to put Sarkozy out of the presidency. So, strategically speaking, if I am a left voter, I go to this primary, I won't vote for Juppé because I know that Juppé is the favorite. So, it doesn't change. What I want is that Sarkozy doesn't end second. So what I have to do is to find the best challenger against Sarkozy. So many people from the left voted for Fillon. And that's explained why you had such a big high result. So what will happen this Sunday, and that will be perhaps the first good surprise for European political, is that Juppé will end first, in spite of Sarkozy saying you should vote for Fillon. Because either people from left say, okay, we have reached our scope, Sarkozy is no more in the run, so we don't need to go to vote again, so there will be less people voting for Fillon. Or even worse, people from the left say, wow, look what we have done. Now we have put Fillon that is perhaps even more at the right at Sarkozy, so we should balance that and now vote for Juppé. So I suspect that Sunday it will be very close call, and you may have the surprise that Juppé, that was only 27, at the end be the candidate for the right. And if it is the candidate for the right, the probability of a win of Marine Le Pen decreased quite significantly. Because Juppé is almost at the center, so he will be able to get also people from the left with him. It's more dangerous if you have the second tour in May, Marine Le Pen against Fillon. First news. Second is Italy. Italy, you have the election on the 4th December. You know, you have seen, even if I tell you I am sure it's a no, I am sure it's a yes, we don't know how to position in the portfolio. Me first. But what I know is that, you know, Italian referendum, it's a good excuse for me, for you, for your clients, to not to be more optimistic on European equities. Why we should buy European equities? You have Italian election in 1 month, in 2 weeks, in 3 days. Once that is behind, I want to listen what is the excuse not to buy European equities. Because probably at that point you will have the extension of the QE, of the ECB. You have Italian election, yes or no, but is behind, it is known. And then there is good reason again to buy European equities. So tactically, I suspect, we are looking at that, we are speaking with Ignacio and Alejandra, that perhaps before year end, we should be a little bit more brave and tactically play a little bit a rebound in European equities. Yes or no in Italy won't change anything. If there is a no, for us, it's statu quo. Things doesn't change. Perhaps Renzi goes out, but Italy remains not, very difficult to manage. But the fact that it's very difficult to manage, it means that extremist party cannot have a majority, which is quite, in the bad news, I try to find the good news. If you have a yes vote, the perception of foreigners are very positive in the short term because they say, look, Italy is able to reform, they give a strong mandate to Renzi, and so now we are heading in the right direction, which is right. But what happened is that in 2018, when you have the next election, if you have a small party that gets a majority, let's say of 28%, he will be able to control all the Senate, not the Senate, the Parliament. And so he will have free hands to govern. So that is the danger.